Welcome everyone to Story Trading. Got a presentation today. We're going to be bringing on Mark Gomes to present Cantaloupe CTLP. First, a couple house items here. Disclaimer: Story Trading is not an investment advisor. That goes for all of our guests and speakers as well, unless they state otherwise. Investing in securities involves significant risk of loss. This presentation is open to the public. Q&A is only going to be for VIP members, but it is being recorded, and we're going to be posting this on YouTube afterwards. Those of you who don't know what story trading is, what do we mean by that? What is a story? What we're trying to do is make sense out of markets. The idea is there's a story behind the chart, right? You could tell a story. Why is it up? Why is it down? Why is it undervalued? Why is it overvalued? So we're trying to make sense of markets, and we do that through crowdsourced research and social collaboration through the lens of the four pillars, which we call sentiment, catalysts, fundamentals, and technicals. Now, today's presentation by Mark Gomes is more of a fundamentalist, so he'll be focusing on that, but we might touch on those other three pillars here and there as well. So with that, just want to also show you a quick little overview about story trading here. All right, so there maybe better explained it better than me. What we try to do with story trading, not necessarily what Mark tries to do, but we love his contributions as a fundamental investor. Over here, we have a Cantaloupe, CTLP. Here's a quick, this is a long-term chart. This company's been around for a long time. So hopefully by after today's presentation, we can get a better idea of the history, why it's had some of these ups and downs, and where it might be going next. And again, we'll do that. With that, I'm going to turn it over to Mark. Mark, thank you for joining us. He's coming to us from Moldova, so really appreciate you taking time out of your schedule there in a different time zone to help us out today.
Sure thing. Yeah, so Cantaloupe's a company I've been following quite some time. They were formerly known as USA Technologies, and those who follow me know that I've been an advocate of their preferred shares for quite some time, but not their actual shares for quite a long time. However, in the current market environment and given where the stock is at the moment, along with their fundamental progress, I think the timing has become right to introduce the story of the company itself to investors. So real easy to understand what they do. If you've ever used a vending machine, they're the ones who make the payment mechanism. So not a very exciting business several years ago. If you think about, the early vending machines, you put quarters in, and if you didn't have quarters, you had to find somebody to give you quarters, and then you feed the machine. Eventually, there was an upgrade cycle where they had dollar bill changers, so you can actually put coins or dollar bills. So, that was a good cycle for the company from that standpoint. And then, of course, credit card, debit card, and that was a nice upgrade cycle for them. Now, in each one of those cycles, though, it was just more of a hardware play, right? We had better hardware to make the vending machines easier, more convenient for users to use different types of money, whether it be coins, then dollars, and then credit and debit cards. Well, now we have something that's more revolutionary for the company versus evolutionary, and that's the move to NFC, near field communications, like you're using your Apple Pay. And the fact that these machines are now internet connected through cellular technology. primarily 3G at the moment. Then there's going to be an upgrade cycle to 4G that's actually underway and is going to be forced towards the end of the year as 3G reaches end of life, end of support. Vending machine operators are going to be forced to move to 4G on those machines, which will be a nice little boost for CTLP and its competitors. But that's not why I care about the company at this point. What I care about the company is, so, if you're a vendor if you're a maker of vending machines, you're relying on a third party for the actual payment mechanism, as we discussed. And let's say you go with CTLP or one of its competitors for the latest technology. You'll accept dollar bills, credit cards, debit cards, Apple Pay, etc. And the machine itself is now connected to the internet. And why that changes everything for this company is that now you can incorporate software into the equation. CTLP actually purchased a company when they were a USA technology. They purchased a company called Cantaloupe, right, who made software for vending machines. And by putting those two things together, right, what you end up with now is a company that not only operates the payment mechanism and takes a little piece of each transaction, by the way, which is, you can imagine, CTLP has approximately 20% of all vending machines in the US, over 1 million vending machines, and they get a little piece of every single transaction. So that's cool. It's a great underlying business. But on top of it now, they own software that allows the operators of vending machines to keep track of their inventory in their machines. Which products are selling. So imagine you've got Coca-Cola, Pepsi, Fanta, Dr. Pepper, and your Coca-Colas are running out all the time and nobody's buying the Fanta. You'll be able to see through this software. The software can recommend to you, hey, forget about Fanta, just put 2 slots of Coca-Cola, right? For an example. Also, in the old way of doing things, and a lot of old operators are still doing this, the more savvy operators are actually buying the old operators and incorporating the software, because what you used to have to do is you send somebody to the machine let's say every week to fill whatever's been sold. Well, now that the machine's connected to the internet, you don't have to do that anymore. You can wait until enough inventory has come out of the machine and then send a guy proactively to refill the machine. The way it works out ultimately, and there's other features, right? There's pricing optimization. There's remote price changing now. It's a new thing that they put out there. And as a result of all this, what the company will tell you is that they can add 15 to 35% efficiency to a machine, which I believe is on the higher end of that now, because you think about gas prices and delivering product to the machines. If you can cut down how much you have to send somebody to a machine, great deal of efficiency. So now what you have is a situation where let's say you had 100 vending machines that you've been operating for 20 years. Those machines are now worth a lot more than they were because they can be operated a lot more efficiently. Not only that, because of the price optimization, they can become higher revenue generating machines. Okay, they can accept any kind of payment. You can optimize the price for optimal profitability, and you can optimize the machine for cheapest operation. Okay, so I'm going to go over some notes that I prepared for this. How are we doing so far, Ben? I can't hear you, sir.
Yeah, thank you. No, we're doing good. I've been jotting down a bunch of questions as you're going, and you've been answering them as you're going. So keep going. You're doing well.
Great. Sounds good. So if you think about this software that they are selling, it's kind of like if you know SAP or Oracle, right? They build software packages to run entire organizations. And when they initially did this, SAP came at from a manufacturing standpoint, and then they started to get into things like human resources and financials and supply chain and everything else. And that's what's happening here, where by virtue of the fact that Cantaloupe is penetrated so many machines, not only with the hardware, but the software, which by the way is compatible with competing hardware, right? They can add more and more and more functionality. And in fact, they're partnering with outside folks that have some nice innovative software to offer. So it's going to give them the ability to not only take a transaction fee, but also take a software monthly fee, but then expand that software footprint so that they get more and more and more per month. And as you can imagine, software has extremely high margins. Hardware has very low margins. So we have a situation where the margins can increase greatly over the next several years. And we're already seeing that in the financials. So I'll get into my notes now directly, but I wanted to give you that kind of summary. And I may repeat myself in some of these things, but I just want to go through the notes real quick here. So arguably the best part of the product is the dynamic delivery routing system. Okay, and that it provides the ability to operators to rapidly change routes and do that in the most efficient way. A typical vending machine operator can be driving 15 to 25 routes. CTLP will reduce that down to somewhere between 12 and 18, driving 15 to 35% savings, like I said, which is moving towards the higher side because of increasing energy prices. Okay, so again, they also help show which products should be in the vending machines, how they should be allocated in the vending machines, and how often to service it. So, and they also recently released an updated handheld version for the warehouse, right, to help manage the warehouse operations as well. Okay, so maybe the most important thing to realize is that CTLP is continually developing and adding new functionality to this set. All right, the warehouse functionality was added in March, and that was closely followed by an AI-enabled merchandising offering, which again, I mentioned earlier, that was actually through a partnership with a company called Hivery, Hivery, and also some remote price change functionality, which is now gaining momentum due to the frequent price changes required in an inflationary environment. So not only with gas prices up, do you want to be able to change the prices remotely instead of sending somebody there to do it, but you also want to do that on a regular basis because, well, the cost of my next, delivery of inventory went up 10%. So now I have to increase my prices 10%. Okay. In addition to that, you can imagine if you have vending machines near, let's say a pavilion, right? Maybe Monday through Friday, where the typical people who work in that area are buying their Coca-Cola, you have that machine charging $1 for the Coke. But then on Saturday, when a concert comes to town, you charge $3. Hit a button from your CTLP console, and all of a sudden your prices are all raised up to $3. And come Sunday or Monday, you drop them back down to the rate that is optimal for that particular time frame. Day of the week, events, things like that. So very makes a vending machine extremely dynamic. Okay, so it helps them to grow revenue. And for example, with these old machines, when they go from cash only to incorporating credit card and Apple Pay, sales go up 20 to 25% in almost all cases, even in low volume areas. Okay, so you have this nice uptick in revenue they can create, as well as this great uptick or downtick in expenses that they enable. And it's only a few dollars a month for this software. And it depends, of course, on how many bits of functionality that you can, that you utilize. But as you can imagine, right, when a typical vending machine has 30 or 40 coils, 30 or 40 slots in it, being able to manage the pricing, the inventory, the complete operations of this, as opposed to having somebody go there every week, becomes a very compelling purchase driver for the company. And in fact, CTLP's largest customers say that they lose between $500,000 and $750,000 per year just from having the wrong price. That alone. Okay. So,
Mark,
now,
maybe this is a good time to pause here because I have a
sure.
related question about like what is the total revenue one machine can make, and do you know anything about like the average profit margins there, and how much Cantaloupe's getting from that, like one cycle of the machine turning over all its product?
Yeah, I don't know on a per machine overall basis how that works. We could probably do the math real easily, right? Because they report their revenue, they report transaction revenues, and they discuss how many machines they have. So it's kind of simple math from that perspective. I just never did it because my emphasis is on their ability to increase the revenue per machine as opposed to the revenue they're getting per machine now, and being able to reverse engineer to figure out how much the machine itself is generating for the operator. But at this point in time, the estimates for this year are for Cantaloupe to generate $200 million in revenue, and I believe they have 1.1 million machines.
About $200 per machine per year. Right?
That sounds right.
Okay. All right. That's good enough.
So what's enabling a lot of this to occur at this point in time is the new management team. There was the old management team when I first started covering the company was very profligate in their spending. They were it was a land grab for hardware. They weren't so focused on the software as much. And so there was an insurgence of activist investors that came in, and that was led. CEO now is Sean Feeney. He joined the company 2 years ago, and the activists were, led by a gentleman who was formerly the VP of M&A for JP Morgan. So you can imagine what his goal is, and it's not something that you only need to infer. You can just look at the last couple transcripts of the company. They make absolutely no bones about their vision for the company to be acquired at some point in the future. And basically it's just a simple matter of they took over the company through the activist proxy, put in a new management team, and that new management team has cut expenses down, has increased revenue, streamlined the operations, and put a strategy in place, as I mentioned at the beginning of this, to make software a much greater part of their ongoing revenue. Now, if you look at their gross profits, right, they went in 2019, their gross margins were less than 28%. This year, I'm looking for that to be somewhere around 34%. So that's a significant increase in just 3 years in terms of gross profits from where they were at the end of 2019. I believe that's going to continue, right? As more and more of their revenue comes from software. As you know, software carries margins, upwards of 90%. So I think we can continue to see gross profits increase year over year to, let's say, 38% over the next 3 years. Okay, which is going to enable the company to generate closer to $1 of profit than what they have right now, which is basically zero. The estimates, I believe, right now for them to generate to be break even this year, to finally go break even after having $40 million of operating losses in 2020, fiscal 2020, which ends June, by the way. I'm using fiscal numbers. So this was a highly unprofitable company, but very promising. So when you look at the chart, the company still had, a decent valuation despite the heavy losses that they were incurring and the lower revenues than what they have today. But now things have kind of reversed to where you've got the revenue after going from 163 to 166, very modest revenue increase last year. The expectations are that the revenue is going to jump to over 200 this year. I believe they can do 235 next year. So very strong, 15 to 20% type growth rates, coupled with increasing gross margins, coupled with greater control over expenses. And I do believe the expenses will increase, but coming off of a lower base than the, say, 85 million of operating expenses that they incurred in 2020. I believe that comes back in to something closer to 65 million. So when you have revenues increasing, gross margins increasing, operating costs decreasing, and on an absolute basis and on a go-forward basis, also decreasing as a percentage of revenue, that all turns into the thing that I actually look for in a company, which is not profitability, but operating leverage. When you have operating leverage, then you can predict future profitability. And for this company, coming from a base of 8.7 million of negative net income, 8.7 million of negative net income in fiscal 21, I've got them doing positive 4 million of operating income this year, which, okay, if you look at it on a per share basis, is going to look very modest, 6 cents per share, whoop-de-doo. But when you understand the operating leverage that I was alluding to, you start to see that this company can start to add about 20 cents of EPS per year, 20 cents of EBITDA per year in the years to come. So all of a sudden, I see that 6 cents becoming 21 cents, 42 cents, 62 cents. And when you've got a recurring revenue business with an increasing software component, and analysts start to see these 62-cent numbers and maybe obviously going to perhaps 82 cents the year after that, you're going to see some real meat on the bone for the valuation, with a decent, a P ratio of, let's say, 30, given the growth rate and the recurring nature of the business. A 62-cent number will account for, will justify a $20 stock price. Now, that's a few years down the road. It's not now. But if you track that back to the present value of that $20, I can see this stock going up 150% over the next year, tripling over the next two, pretty simply. Okay. So let me pause there. There's other stuff that I can share, but maybe you have some questions you want to ask, and then I can add a little bit more to this equation. I'm not hearing you.
All right. Sorry about that. Keep forgetting about the mute button. I said, while you were talking, I was putting some visual cues up. I don't know if you're able to see that, but if there's any particular metric or something you want me to show people here, we could do that. I do have one. This is fascinating. It's like so amazing how many different ways there are to make money in the world. And
Crazy,
this is this is a business I've never thought about. Even though I use them and I see them every day, it never dawned upon me that this could be a a profitable business, or what's the publicly traded company behind it. I never thought about it. So it's really fascinating. And I had a question about this. I love the remote price changes and the surge demand type of pricing possibilities. Very cool. I could definitely see how that could really increase revenue for these vending machine operators. Is there such a thing? Is there a software in here where there's shared intelligence across the entire network, where the software can recommend what products are selling best, or not necessarily in that particular vending machine, but across all vending machines? Because, I would use vending machines much more often if they had the product mix I wanted. Once in a while you find a vending machine with the food that's maybe a little bit healthier, but most of the time it's all just pure junk, right? So I'm not buying anything, right? But if they had at least raisins or nuts, I might buy something. So do you know if that's something they've talked about, or is that intelligence that, people don't want to share with each other?
I mean, at this point in time, I would say no. But considering that their largest customers have enormous fleets of vending machines, I wouldn't be surprised if there is just about anything that these guys, if you can imagine it, it can be incorporated into software. So where I don't necessarily see, for competitive reasons, competitors sharing information, I do believe that we're going to see something like that, because there is AI being incorporated for these large fleet operators, and the vending machine space is consolidating rapidly, right? As you can imagine, you know, if I was the type of person to do this, if I was kind of a serial entrepreneur, this is absolutely a business I would get into. You know, there are many businesses that kind of come my way and say, yeah, you know what, this is one that I would want to get into if I was the type of person to get into businesses. You can go out and find all of the vending machine operators out there that have just been sitting on their vending machines as is for the last 20 years, not upgrading the machines, not realizing there's this kind of optimization technology out there, and just taking their cash cow. They purchased these vending machines 20 years ago, and they're just collecting a check. They got some guy going to all the vending machines, filling them up, and they collect a check every month. And what do they care or know about the possibility of making those things more profitable? So you can acquire those machines. You can approach those owners, acquire those machines at a multiple that seems attractive to the owner, and then quickly think about it. If you increase the profitability of a machine by 20% and decrease the costs associated with it, or the efficiency, by 30%, you can increase the value of those machines by 50% pretty quickly.
All right,
Just
let me
by
just a little confusion on the business model here. Cantaloupe, are they do they also sell the machines, lease the machines out? Are they making money on that end, or just the software?
No, simply the payment mechanisms
So
and the
they
software.
can upgrade the payment mechanism inside. They go
Yes.
in and reverse engineer, they take it out and they put a new one in, and it's the same old vending machine.
Yeah.
Oh wow,
Yeah.
I
You
didn't
can.
know that.
Yeah.
Interesting. Okay. Well, we have a question. If you're a VIP member, I know some of you here. You can just if I know you, you can raise your hand or put it in chat, and we'll take you. Rory, Todd, Cass. We got a few other people here in our community. If I don't know you, if you're coming in from one of the public links, then please put in that VIP code if you are a VIP member. If you have a question, I have a question that came here.
One last thing before we go to Q&A. I just wanted to.
Sure.
Yeah, I just wanted to emphasize, just kind of on the end, I gave you a little bit of the valuation analysis. The thing that I failed to mention right before that is that we do have quite a bit of insider buying that has taken place starting at the end of May. So they've been purchasing quite a few shares from May right through mid-June. There's quite a bit of insider buying. And, you know, when you think about the management team coming in, you know, led by a person from Wall Street, you know, to me, that provides a little more oomph, right, to the story, because you're talking about guys who know what this thing's worth. They know what they're dealing with. They know what they're going to be able to turn it into, and they have a goal, pretty obviously stated goal in, you know, if you read their transcripts, of eventually selling the company, which brings in a very brief discussion of CTLPP, which I also believe is a great bargain at these prices, because what CTLPP does, it's a liquidation preference. And just to simplify it, CTLPP is an instrument that will pay out in the event of a bankruptcy or a acquisition. In other words, a liquidation event, if the company gets liquidated, right? Now, bankruptcy isn't happening. That's 99.999% off the table. But if it does, we already did the analysis, and we determined that the shareholders of CTLPP would be paid in full, and I'll give you the numbers on what that paid in full means, in the event of a bankruptcy. And obviously, in the event of an acquisition, that would also occur. They would be paid in full. So how you get paid is this. The liquidation preference at present is worth approximately $49 per share. It also pays a dividend that remains captive to CTLPP of $1.50 per year. So at present, CTLPP has an intrinsic value in the event of liquidation of about $49 a share, but 12 months from now, that'll be $50.50 per share. The year after that, $52 a share. So you get this increasing value on this current asset, which is only trading for $33 a share, right? You're getting this $1.50 dividend, which is about 5% dividend, right, for doing nothing. And when it gets acquired, which is their stated goal, this thing instantly goes up to that full value, instantly. So for folks out there that are looking for a place to hide out in this environment, CTLPP, this is why CTLPP has been one of my largest investments, is because you're getting this 4.4% dividend on an asset that is only going to continue increasing in value and then instantly hit that intrinsic level of 49 or 50 or 52, however long it takes them to decide to sell the company, instantly get that value, which at present is a 50% profit on something that has virtually no risk.
That's what I was going to ask you. What's the downside here?
I mean, the biggest downside to CTLPP is that they don't go bankrupt or get acquired for the next, let's say that you're holding this thing for 10 years, right? You're still collecting the $1.50, right? And the intrinsic value continues to increase as a result. And so the only issue is, are you okay with sitting on something making, that 4% per year, waiting for an acquisition that may never come? But the point is, the management team in place has a stated goal of selling the company. So if that occurs in, let's say, 2 years, right, you're going to make that 4.5% dividend twice. So that's close to 9%, plus the 50% uplift in the value of the equity right now. So you're talking a 55% return over 2 years. That's almost 25% per year on something that really has no downside, except for the fact that you're only making that dividend until that event hits.
So which one do you like better here between the two? Do you mind? I don't know, whatever you feel comfortable telling us about allocations, or mostly in the preferred, mostly in the common?
Yeah, so I am mostly in the preferred. The preferred is still it's one of my largest positions. It's one of my top 5 positions and has been. I've owned it for quite some time, for years, in fact.
Oh, wow.
It's got a great place in my portfolio. Yeah, for me, I think it's a great place in my portfolio. I especially love to own this asset in bear markets. This thing is held up like a champ. The intrinsic value only continues to increase, but of course, supply and demand can move the shares down in an environment like this. But it's not something that happens because the people that own these shares are holding on tight. I want this to continue to be a large percentage of my portfolio, and there are less than 500,000 shares of these preferred, and they will not increase from that level. This is, the share count of a common stock, increases year after year unless there's a buyback. But this is a preferred stock; it's limited, so it's kind of like an exclusive club. And I believe the founder is perhaps the largest shareholder of these preferreds, and you can bet that he's not looking to get rid of that until the company gets sold, which he knows is going to happen at some point in the not too distant future.
No, I actually have a question on the preferreds from one of our VIP members, Sanjay. He says, given the huge payout to preferred shareholders, how could that affect the acquisition price?
It's not a huge, so think about it this way. There's 500,000 shares outstanding, and the intrinsic value is about $50. So that's only $25 million. So, a company going in to acquire these guys is going to know right off the bat that they got to pay out this $25 million right off the bat to the preferred shareholders. Not that they care, because the price they're willing to pay is the price they're willing to pay, right? It's just a matter of whether the common shareholders are okay taking that total acquisition price minus the 25 million that first goes to guys like me that own that preferred. But it's only 25 mil. Now, so if you look at that compared to what the stock is today, the valuation on the company at the moment is 390 million. And if we're talking about that tripling to somewhere closer to 1.2 billion over the next couple of years, 25 million is a drop in the bucket.
Okay, great. I got some questions flowing in. Was there anything else you wanted to add, or can we go to more questions at this point?
Yeah, we can go to Q&A. Thanks.
Great. We got one from more. Okay. Chris Tuttle, who you know. Are these guys likely to purchase any of the other companies in this space to consolidate their position? Companies like Parallel, Vensoft, etc.
Yeah, so it's possible. Obviously, with a head of M&A, at from JP Morgan, tightly involved here, they could do that. Obviously, they've already made acquisitions. They purchased Cantaloupe. They also acquired a company called Yoke, which is going to take CTLP beyond the vending machine part of the business into other unattended spaces, right? You think of vending machines. Vending machines is part of a larger category called unattended, which can include, like, think about air and vacuum machines at gas stations, EV charging stations. Those are all unattended, and Yoke takes CTLP beyond the vending machine part of it and into other areas of unattended. And so, yeah, I think acquisitions is going to continue to be part of their strategy insofar as it helps towards the goal of getting them acquired, which is the ultimate goal, I believe, of the management team.
Okay, great. A couple other questions here. Got one from Todd. Have they completely resolved the legal issues from 2018 to 2019? You know what that's about?
I'm not sure if everything's completely cleared up. My sense on all that is that if it's not, we're going to have a fair resolution. I thought their biggest issue that I've seen with this company, really, to me, the biggest risk was in the financials. Whether the financials were misstated, things like that. And they went through this whole process, and that was part of what kind of helped lead to where we are today. I think you're dealing with a very clean company right now. They've cleaned everything up, and they're really focused on growth, profitability, and getting this thing primed for acquisition by a larger player.
Okay, great. A couple more questions here. This one again from Sanjay. CTLP earns most revenue from transactions. How's the trend there? With a lot of people are still working from home. So that's an interesting one. When people are working from home, that could decrease revenue potentially.
Right. Absolutely. And it certainly was a drag on revenue. And by the way, continues to be a drag on revenue for that reason, because not everybody has gone back to the office. And yet they are tracking towards 20+% growth this year. So, people going back, let's look at it this way. Do you believe that more people are going back to work, or more people are going to be leaving the office, right? Obviously, the trend right now is back to work as opposed to leaving the office. So that's a net tailwind for them. And even as the world increasingly becomes a work at home type of thing, these vending machines will get moved to optimal locations if need be, and things of that nature. But what you see right now is tremendous growth occurring as the world does go back to work, and then we hit some kind of level of normalcy, right? A certain number of people are going to be working at home, a certain number of people are going to be working in the office, and that's going to stabilize. And then as workforces and inflation kicks in, of course, inflation is actually good for these guys, right? If you're getting a piece of every transaction, then a piece of a bigger transaction is more revenue. As more revenue comes into these machines, the whole notion of becoming more efficient, right, to offset the inflationary impact on expenses also becomes more interesting. So, if you, again, I would highly recommend their last couple of transcripts, and you will see it's an extremely rosy picture that the management feels. They're very bullish on what's happening right now in the environment and how that benefits them. So this is to me, this is a company that is well suited for this sort of environment.
Okay. Great. I got 3 more questions. They keep coming in. Yeah. How much time do you have, Mark?
I'm fine.
Okay. Oh, this is interesting. Just a comment from someone saying, when their office went back to work after COVID, they did it in a hybrid environment. And as part of this, they lost their cafeteria and gained a dozen vending machines. That's interesting.
And that might explain why revenues are coming back so strong. That is an interesting point. I hadn't considered that angle. But what I will say is that does actually feed very well into what happened as a result of COVID. Is not only did it send people out of the office, which was a negative for these guys, but it also increased demand for unattended retail. Right? There's still millions of people out there that would prefer not to deal with some random person behind a counter, given the choice to purchase an item from a machine instead, right? Plus, in an environment where you see rising labor costs, right? You see increased unattended, checkout at grocery stores, right? And so you're going to see, and there is innovation here. If you look at, I forget what the name of the association is, but it's, the Unattended Retail Federation. There are more and more innovative, unattended vending machines, for lack of a better word, being developed for more and more types of items. So it's not just sodas or candy anymore. You're going to see a whole slew. I believe in the future, we're going to have entire storefronts of unattended stores. You're going to walk in the store and you're going to be able to purchase, whatever. And there's not going to be a checkout person or what have you. It's going to be NFC. You're going to buy it out of a machine for the security purposes, what have you. And this all feeds in favorably to CTLP in the future. So that was a great comment.
All right. Sounds good. Can you talk about competition a little bit? You said they had a 20% market share, which is 1 million machines, right? How's that trend going? Are they stable? Are they gaining share? Are they losing share to competitors?
Yeah, I think it's fairly stable from that perspective. I think what's more important, because the hardware is an extremely competitive space. To make a device that accepts dollar bills and debit cards and Apple Pay, that's easy. That's easy. But what isn't easy and more profitable for that matter is coming up with an entire suite of software like they have. So from the perspective of the hardware side of the equation, highly competitive. You can expect it to continue to be highly competitive. And I wouldn't expect significant market share gains for the company unless they acquire it. However, as I mentioned earlier, their compatibility with competing devices makes that virtually irrelevant. Right? It certainly helps for them to have that 20% installed base market share because it gives them the in with the customers to say, hey, I have this software. Hey, we've got this new software. Hey, we've got this new functionality, right? But as their profile grows amongst vending machine operators, and by the way, as vending machine operators acquire other vending machine operators, the savvy ones are using this software, and that's really what I'm looking for, right? I care more. I wouldn't even care if their revenues decreased if the revenue mix was more software oriented. Because again, if you look at those gross margins, they're only in the low 30s. That's nothing for a company who 10 years from now could be dominated by software, as you can imagine.
Okay. Great. Got a question. Last one I have in the queue. How's the arrangement work with Visa, MasterCard, or that transaction, right? Is it like one blended fee? Do they have a deal with Visa, MasterCard and they pay them, or are these all separate? Who do they get paid by?
I'm not exactly sure how that works. I think that's pretty standard though, because Visa, MasterCard take their cut and they probably just process that cut. But it's a good question. I don't have the answer to that. Whatever it is, it's
who's making the bulk of the profit here? Is it the location, the landlord or whatever putting it there, or is it the vending machine operator? Who's getting the upside of these price changes, these remote price changes and stuff?
Yeah, I mean, I think it's clearly the operator. For that specific question, it's clearly the operator of the vending machine. I don't know who has greater profitability right? Because I don't have access to the financials of these vending machine operators. So, if you think
What do
about
they
a
do? Do they
vending,
pay? They pay like a fee to rent a location out. So is
a,
that to the vending
ven-
machine
a, ven-
operators?
a vending machine operator,
Yeah.
yeah, yeah, you're kind of delving into the vending machine industry itself that I'm not as familiar with. I'm more familiar with the role that these guys play.
Okay, I have a comment from Sanjay. I don't fully understand here regarding that Visa MasterCard question. He says CLTP pays to Visa MasterCard as well as for the vending machine connectivity to Verizon, AT&T. GM is after those
Right,
costs, gross margin. Do you understand that comment?
right. Because they have to. So the credit card companies, the Visas, the Mastercards take their cut right off the top, and like I said, it makes sense that CTLP would provide that directly to them. But also, these machines being connected to the internet via 3G and 4G infrastructure, right? Well, you got to pay a carrier for that. It's not free. So
Who
that's
pays
where
that? Who pays the carrier?
I believe that CTLP pays that, but it comes off the top, right? So it ultimately it's being paid by the vending machine operator.
So they're really providing kind of a full service here,
Yeah,
right?
pretty much.
They get a nice cut, but they're handling the payment to 3G, 4G operators, so the credit card company. Looks like they're doing a lot. It's kind of hands off for the vending machine operator.
Yeah, and again, I would have to check into that to make sure that what I'm saying is 100% correct,
Okay.
right? But yeah, I think what's very important to take away is that they handle as much as humanly possible to minimize what the vending machine operator has to do, down to acquiring the machine, deciding where the machine goes, and having the personnel to maintain those machines, right? If they can narrow it down to that level, right, and provide a software dashboard or platform that from where the big boss can just log in and say, okay, how does my fleet looking, right? That's the kind of level of automation that these vending machine operators are looking for out there now.
Okay, cool. Well, fascinating learning about this industry. I knew nothing about it. It looks like a solid company. So those of you who are interested in looking at this more, definitely continue talking about that in the story trading community. Mark, where can people find you? Any other closing comments on this?
Sure, I'm at Mark Gomes Stocks, MarkGomesStock, 2 S's in the middle, .wordpress.com. The first article will tell you everything you need to know about me and what I do. And I will be providing my operating model for CTLP there. And appreciate the time.
Right. And also, Mark's always invited to collaborate in our own room. We have the CTLP research room for our VIP members that we opened last night. If you want to continue talking about it there, definitely follow us on YouTube and Story Trading. We have another event coming up Monday night. This one is strictly for Story Trading VIP members. It's going to be on CLFD. That's a VIP pick from Chris Tarbert. It's been doing awesome. Mark, I think you're familiar with this company too, right? CLFD.
Which one was,
CLFD.
Yeah, Clearfield. Yeah, I've known Clearfield for probably 20 years. CEO Sherry Baranek.
Yep.
Great.
We had her once present to us. She was great.
She's phenomenal. This has been a great company for a long time.
Awesome. Getting your validation and endorsement on that. So yeah, we've been on top of that story. Chris has been on top of it. So he'll be providing an update Monday night prior to earnings, which I think is coming the following week. So if you're interested in that, you can sign up at our website, storytrading.com, and we'll collaborate there. Mark, thank you so much for your time. Appreciate it.
Sure thing. Take care.
Take care. Bye-bye.